Hello, fun party people. It's Ronald again, back with another video. One of these somewhat shorter form things I'm trying out. In this one, we're going to talk about various ways you could add real estate exposure to your portfolio. Many people think of real estate and they imagine things like flipping houses or being a landlord. And these are certainly ways of exposing yourself to the benefits of owning equity in the real estate market, and they can be very profitable. But they have very high buy-in prices, and many people are turned off by that as they feel that maybe they'll never have that type of money to spend, they don't want to prioritize it, or they just find it inaccessible for whatever reason, potentially just because they don't have the expertise and they don't know how to go about gaining it. Well, today I'm here to tell you that while these are certainly valid ways of getting into real estate, I guess if you were to put all of the different ways we're about to talk about today onto a ladder, probably amongst the most profitable ways to get into real estate. If you have even a few dollars, you can add real estate exposure to your portfolio today in a couple of ways. So we're going to go over a few of these, reviewing the pros and cons of them as we go. Let's start with REITs. A REIT is a real estate investment trust. This is probably by far the most accessible way to gain exposure to real estate, and the one that I have most personal experience with. If you have a brokerage of any kind, even something as basic as Robinhood or my preferred M1 Finance, watch my portfolio reveal if you'd like more details on that. Link in the top right. You can buy REITs. Basically, a REIT is a real estate company that owns multiple properties, often of a certain type. Like, for instance, Simon Property is a mall REIT, so they own malls. Blue Rock Residential Growth is a residential REIT. Realty Income, my particular, my personal darling REIT, is like more of a commercial REIT. They rent out to companies like Walgreens. Then they lease to, customers on a single, double, or triple net basis. We'll go over the concept of net leases in a future video on REITs specifically. So don't worry if you don't quite get the terminology of that just yet. Now, REITs are a tax-advantaged entity that are required to distribute 90% of their taxable income to shareholders in exchange for not having to pay corporate tax at all. Now, actually, there are also things like mortgage REITs, which don't really own properties. They own mortgage debt instead, and hybrid REITs, which own both mortgage debt and actual equity properties. But once again, these details, future REIT video. I'm not a huge fan of mortgage REITs, to be honest. I stick with equity REITs. We'll talk about it. Basic takeaway on REITs is that they are bought and sold like any publicly traded company. Actually, there's non-publicly traded REITs as well, but they can be difficult to value and you kind of have to have the conditions for them. But anyway, the basic takeaway is that they will pay you regular income in the form of dividends, which are typically unqualified. We'll talk about that in a second. Which, of course, brings us to the pros and cons of REIT investing. One pro is that a solid REIT, like I was just saying, is a steady source of income that you can dollar cost average into and expect rising returns as they raise the dividend, and potentially, with just straight up appreciation of the value of the stock. So there's, dividend aristocrats like Realty Income that are great examples of how that works. They pay, monthly dividends. It's never gone down ever. And their whole slogan is about how the dividend is sacrosanct and how they'll never cut it. Others, just like any other type of company, they'll pay, quarterly dividends and sometimes special dividends. It happens. They're almost like, if you look at my stocks video, they're like any other company. But they are really focused on paying you dividends. And actually, the way that you analyze REITs in terms of their value and stuff is different from a typical stock. You'll typically be looking at the AFFO as opposed to something like PE ratio and stuff like that, as far as valuing them and seeing how healthy their income streams are and whether or not you'd be comfortable investing in them. The con that comes with this is that REIT income is taxed as regular income. So you'll pay a higher tax rate. So if you're paying, like 30s, 40% tax rate in a higher tax bracket, you're paying that rate of tax, as opposed to the capital gains rate, which is, like 20% at first after a year of holding, or with certain income requirements, down to 16%. But on top of that, you gain real estate exposure without any of the benefits of equity accumulation. You don't really get any tax deductions for, holding REITs. A pro here is that you can expose yourself to markets that you'd otherwise be unlikely to break into, like, for instance, just commercial real estate, right? Another pro here is the liquidity of REITs as an investment. If you buy a house or some other property, that money is stuck in the deal until you find a buyer. But if you buy a REIT, you could theoretically, literally sell it the same day on the exchange you bought it on. Another con is that REITs are often influenced by the fluctuations in interest rates. So when, potentially in the near future, the Fed says that rates are going to be going back up after the Rona, REITs may well take a dip. Also, different types of properties will have specific types of risks. So, for instance, Vici, which is a luxury experience REIT that owns a lot of big buildings in, like, Vegas, things like the Bellagio and stuff like that, might be a riskier investment in an environment where, maybe you have another lockdown. However, they didn't really have much of a hit during the first lockdown. Once again, we'll see. The point is specific risks. Hotel REITs, for instance, are often sensitive to recessions. Next, let's talk about crowdfunding platforms and syndication. The terms syndication and crowdfunding are often used interchangeably. Technically, however, they aren't the same. A syndication is the name of the actual relationship between the person doing the work, the sponsor, and the investor who contributes the money. So crowdfunding is a way for sponsors to find investors. Crowdfunding and syndication are going to require a bit more upfront capital to get into than REIT investing, but typically less than becoming a landlord or flipping, investment properties. Basically, you pool your money with other people, so that's the crowd part of crowdfunding, so that you can, help give an entity buy a property, then they make money off that property, and then they pay you back distributions on top of what you gave. Typically, the timeline of that is over the course of some years, which is a little bit different from, like, for instance, holding a rental property and renting it out for years and years and years. And it's also different from, flipping an investment property over the course of, like a couple of months maximum. So it's kind of in between these. Examples of crowdfunding platforms that facilitate these types of deals are, Fundrise, Prosper. There's a bunch of others. And one thing to know about, differentiating between Fundrise and Prosper and stuff like that is, there's the concept of an accredited investor. You got to make, basically, as an individual, like $250,000 a year reported taxable income. There's a different amount if you're, married. Fundrise will let you invest if you are non-accredited. If you're accredited, Prosper might make more sense. You can enter syndication deals without crowdfunding, but you may have to really look or just otherwise have, connections. Because technically you're not allowed to advertise syndication deals. So the first con here is that unlike REITs and, this and every other investment type we're going to be talking about from here on in, these are illiquid investments. Once you're in, you're in. You can't just kind of get your money back immediately. And you're here for the whole ride, whether it goes well or bad. Syndication, unlike REITs, however, do come with tax advantages. You get taxed at the capital gains rate for your profits, and because you are an investor and the sponsor's doing the work, the IRS actually counts this as passive income. You get depreciation deductions, meaning that your taxable income will be less than the amount that's distributed to you. It allows you to tap into the expertise of individuals that have more experience than you doing business in real estate. So that's another pro. And on top of that, you get all of these advantages without all the work required to directly own and manage a property yourself. The most important and work-intensive thing that you have to do in this investment modality is due diligence, both on the deal itself as much as you need to feel comfortable, and perhaps more importantly, on the sponsor you're giving your money to. So there's definitely instances where sponsors have just like taken the money and run. You gotta find somebody with a good track record. You need to find somebody who knows what they're doing. And part of that is reputation. Part of that is looking at the deal and being like, okay, maybe they found a really good, deal. They found a good investment. What types of investments could they be? Could be all kinds of stuff. It could be single-family residential properties. Could be multi-family residential properties. Could be, storage. Out of all these things, out of those options, honestly, I personally am going more in on the storage angle and the multi-family home. Storage is actually relatively recession-proof if you're only paying $60 for a storage unit. Oftentimes, if the price goes up or down a little bit, people will, if they really need the space, they'll just keep, paying it. There's less of a vacancy risk, and there's much less overhead. Multifamily has a couple of those things where it's like, even if there's a certain amount of vacancy, you could still bring in enough income to really make the investment worthwhile. We're going to go over that in detail in another video because I'm a huge fan of the idea of syndication because frankly, doctor, I don't know if I'm time to get super into this myself, but I'd really like to get into real estate investment. You get a lot of return, you get the tax benefits, but it'll be a while before I feel like I have enough time and just willpower to focus on getting good at real estate, valuing and negotiating, stuff like that. Of course, there's some obvious issues here as well. As we mentioned a minute ago, you're giving your money to another person and trusting that they don't screw you. So there's a serious counterparty risk here if you invest with the wrong people. And you don't really have much control over this type of investment. As well, you'll be at the mercy of market volatility. So once again, you're locked in here, right? And while there are tax advantages by the numbers, you'll probably be forced to hire an accountant to help you file the required K-1, which complicates tax time. I actually sold all of my MLP holdings last year when I realized that I would have to file a K-1, which doesn't seem worth it for master limited partnerships unless you're just wildly bullish on the energy sector. Which, I guess on a conceptual level, should be wild. But that's a more complicated issue. Anyway, we could go into similar investment structures like real estate investment groups or REITs, and even subcategories like real estate limited partnerships or RELPs. But I think I'll save those for another video as well. Now let's talk house hacking, being a landlord, and touch on alternative options like renting out rooms. So house hacking is basically where you buy a place to use as your primary residence. So this is something we'll touch again. This is your primary residence, while at the same time renting out a part of the unit. For instance, if you buy a triplex, which is basically like 3 residences glued together, and then live in one while renting out the other 2, you can potentially cover the cost of mortgage entirely, while also making a nice, net positive income off the deal. You could do this with also a duplex or a quadplex. The more that you have like a quadplex, it kind of hedges you against vacancy a little bit as well, because if you have 4 units, you're paying the mortgage on them. You may only need to, fill 2 of them to cover the monthly payments. This, by the way, this is where we get in the realm of being a landlord. In this case, one that lives next to his tenants, which I guess could make things awkward, but whatever. House hacking allows you to live for free while often making a tidy profit. Of course, there does kind of come at the expense of privacy a little bit. Usually these walls are a little thin, you know. The little cousin to this option is simply renting out a room in your own house, perhaps with a platform like Airbnb. A word on this before we go back to house hacking and landlording and stuff like that. So renting out a room feels a little bit more accessible to a lot of folks than, you know, straight up real estate investing, as it doesn't really require you to do much on top of simply owning your own place. The downside is that income, depending on your location and the attractiveness of what you're offering, may be fairly sporadic. People aren't really renting a room for, you know, years on end most of the time, and the likelihood of frequent vacancies is a big asterisk on this option. Okay, so we're back to talking about being a landlord. One thing that all direct real estate investors will tell you about is that it's a bit of a slog. It's hard work. The amount of upfront work that it takes to make this function can make it a bit more like a straight up other job than, you know, a passive investment stream. On top of this, you'll have to deal with tenant issues and repair costs. Of course, you can pay a management company to you know, do this for you, which will bite into your margins. Another thing that will bite into your margins is vacancy, although hopefully not nearly so much as, you know, renting out a room will. Otherwise, you're going to lose some money. You have to cover, you know, mortgage and other costs during vacancies, during which time, obviously, you know, you're only losing money. You're, you know, doing extra work to try and fill the vacancy. So, you know, vacancy is a big issue if you're not in a good area or you're not competitively priced or something. And of course, as we talked about in the beginning, many will find this somewhat inaccessible given the upfront capital it takes to get started. But of course, there's significant positives to this as well. We've already gone over some of them. The tax deductions are certainly one. Your expenses managing and taking care of the property can be deducted from your taxable income, which can really add up. Properties can appreciate on top of earning rent, so you can make some serious gains here. Once again, location is huge. And finally, let's talk about investment properties and flipping. Investment properties are not used as a primary residence, unlike house hacking, and are intended to realize some return on investment. This can take the form of rental income or flipping a house. As we've already elaborated on rental income, let's focus on flipping for a moment. Flipping is something I've admittedly never tried before and don't really plan on doing. It doesn't really strike me as a beginner's game. You need to be fairly astute at valuing properties and to be able to recognize the value of a deal being greater than its asking price. On top of that, you should be able to negotiate that asking price to maximize the profits that you get out of this modality. A lot of the time, flipping is played as a short-term game. Actually, virtually all the time, it's a short-term game. You aren't really looking to hold the property long-term and therefore, you know, pay mortgage, property taxes on it. The more you hold it, the more the cost will cut into your final margin. Now, you can either recognize underpriced properties and sell them as is at higher prices, which is flipping in its purest form. Or you can do renovations and add value before you sell. Although once again, you're going to want to do that as quickly as possible, and you're still going to have to recognize, you know, the value in the property as reasonably priced, because you don't want to overpay it, regardless of how much value you want to add. And this approach will often limit how many flipping projects you can take on at once, compared to just pure flipping. And there you go. Broad overview of ways you can get started in real estate investing as soon as today, especially with REIT investing. This was basically presented in order of accessibility. So you may find yourself passing your money, you know, through the various options in this list as you advance in life and accrue capital and experience. My question, of course, for you is, do you invest in any of these modalities? Let me know in the comments and share your experiences. As always, please like the video if you liked, dislike if you didn't. Don't forget to subscribe, as I'd really appreciate it. And I'll see you in the next one. Stay learning.